Hey there, financial navigators, and welcome back to the channel. Today, we're diving deep into the fascinating and often volatile world of hard-to-borrow stocks and potential short squeeze candidates. Our spotlight today is firmly fixed on a microcap name that's popped up on our screeners, SGLY Future Technology Limited, trading under the ticker SGLY. We'll break down exactly what makes SGLY a hard-to-borrow stock right now, what that means for its potential, and the critical factors to watch for. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. Let's get straight to it. SGLY Future Technology Limited, or SGLY, operates in the industrial sector, specifically within integrated freight and logistics. This Chinese and US-based company provides a range of integrated logistics solutions, from transportation and warehousing to customs clearance and last-mile delivery. It's a microcap stock with a current market capitalization of just $2.03 million. Show SGLY logo/chart. Looking at the recent price action, SGLY has seen some significant downward pressure. Today alone, it's down 25.29%. Over the last 5 days, it's dropped 42.76%, and in the past 30 days, it's down 36.70%. Volume-wise, today saw 1,244,273 shares traded, which is roughly half of its 30-day average volume of 2,348,806 shares, giving it a relative volume of 0.5x. What is cost to borrow and why it matters? So, why are we talking about SGLY? It boils down to its cost to borrow, or CTB. For those new to short selling, when you want to bet against a stock, you borrow shares from a broker, sell them, hoping to buy them back later at a lower price to return them. You pay a fee for borrowing those shares. That fee is the cost to borrow. When this fee is very high, it's a red flag indicating either extreme demand from short sellers or a very limited supply of shares available to borrow. The fees are annualized, meaning a 100% CTB means you pay 100% of the share price over a year to borrow it. Many microcap stocks can see CTB rates well into the hundreds, even thousands of percent. Why this stock is hard to borrow right now? For SGLY, our screeners show an astronomical cost to borrow fee of 732.9% annualized. Highlight CTB number. This is an incredibly high rate, signaling a significant burden for anyone currently shorting SGLY. While we don't have information on current borrowable shares available, its estimated float is around 7.3 million shares. Our internal composite squeeze score, which combines factors like CTB, borrow supply, float, and price momentum, gives SGLY a score of 40.7. This isn't the highest score we've ever seen, but the 732.9% CTB is definitely catching our attention. Squeeze mechanics explained. Here's the basic idea behind a short squeeze. Short sellers bet a stock will go down. If instead the stock price starts to rise, their losses mount. To limit these losses, they're forced to buy back shares to cover their short positions. This buying pressure then pushes the price even higher, forcing more short sellers to cover, creating a rapid upward spiral of short squeeze. A ridiculously high cost to borrow, like SGLY's 732.9%, adds immense pressure. Every day, those short sellers are paying a hefty fee just to maintain their position. This accelerates the timeline for them to make a decision. Either their conviction that the stock will drop is strong enough to justify those fees, or they get out. But remember, a high CTB does not guarantee a squeeze. It can also mean short sellers have very strong conviction that the stock is headed lower, and are willing to pay those high fees to stay in their positions. Dilution risk check. One of the biggest killers of a short squeeze thesis, even with high CTB, is dilution. Dilution occurs when a company issues new shares, increasing the total share count and often depressing the stock price. This can provide an out for short sellers, allowing them to cover their positions by buying newly issued shares without necessarily driving the price up. Highlight section for SGLY. Our check revealed no recent dilutive SEC filings like S-1, S-3, or 424B in the last 90 days, which is a positive sign from a short squeeze perspective. Recent reverse split watch. Now, this is a critical piece of information for SGLY. The company executed a 1-4-14 reverse stock split on July 27, which was just 25 days ago. What does a reverse split do? It reduces the total number of outstanding shares and proportionally increases the share price. So, for every 14 old shares, you now own one new share, but it's worth 14 times more. This also reduces the float, the number of shares available for trading. Historically, we've observed a pattern with many microcap stocks where they tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market digests the new share structure and price. Emphasize this as a historical pattern we've seen in some microcap names, not a guarantee for any specific stock, but it's a noteworthy characteristic of the current SGLY setup, placing it right within that 1 month window. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For SGLY, given its incredibly high cost to borrow of 732.9% and its recent reverse split, what should you be watching? Keep an eye on the borrow rates. Any further increases or a significant drop in available shares would be notable. Also, watch for unusual volume spikes on upward price movement. Given its current relative volume is at 0.5x, a surge could indicate increased interest. And, of course, monitor how the price action develops within this roughly 1 month post-reverse split window that historically can bring added volatility to microcaps. Singularity Future Technology Limited, SGLY, presents an interesting case study with its astonishing 732.9% cost to borrow and recent reverse stock split. While the current price action has been bearish, the underlying mechanics of a very high CTB, combined with the post-reverse split observation, make it a stock worth understanding from an educational perspective for short squeeze dynamics. As always, do your homework, understand the risks, and never trade based on speculation alone. If you found this breakdown helpful, please hit that like button, subscribe for more in-depth financial education, and let us know your questions about SGLY or hard to borrow stocks in the comments below. We'll see you in the next video.